Hello, everyone. Welcome to our January 2023 investor call. My name is Jeremy Capron. I'm the Director of Research here at ROBO Global, and I'm talking to you from New York. And with me today, my colleagues, Lisa Chai and Zeno Mercer, and we are going to talk robotics, automation, AI, healthcare technologies. We're going to share some thoughts about the recent market developments, and then we'll take a closer look at some of our index portfolios. And the first one is ROBO, ROBO. That was the first robotics and automation index. It started more than 9 years ago in 2013. The second one is THNQ, THNQ. That's the Artificial Intelligence Index. The third one is HTEC, HTEC. That's the Healthcare Technology and Innovation Index. And these portfolios combine research with the benefits of index investing. They are composed of best-in-class companies from around the world. We have small, mid, large caps that we research and we score on various metrics, and the higher scoring stocks make it into the portfolios. And then we'll be taking your questions, so feel free to type them into the Q&A box at the bottom of your screen. And I think for all of us in the investment industry, we're glad to turn the page on the year 2022, which certainly was one for the history books in terms of the hardships delivered to equity and bond investors, but especially to big tech, where we've seen some of the most brutal declines after 2 years of euphoria. And the ROBO Global Innovation Indices were not immune to that, and they underperformed global equities for the year 2022, but certainly not to the same extent as some of the more concentrated disruptive technology indices out there. We think this new year, 2023, is a year of opportunity because there's a huge contrast between the declines that we saw in the stock market and what automation companies are telling us and showing us in terms of their record order intake and their, in many cases, record order backlogs. So in the final quarter of the year, the ROBO Global Innovation Indices saw pretty good gains and some green shoots that may be setting the stage for growth to come. So let's start with robotics and automation and the ROBO index portfolio that was up 12% in Q4. It outperformed global equities by a little more than 2 percentage points with some pretty strong gains in Europe that was up 25%, and also in logistics automation that was up some 20% or so. And I think it's worth discussing today logistics automation here because this is an increasingly important part of the robotics industry, and many investors in public equities are just not exposed to this massive growth opportunity. In fact, since we launched the ROBO Index in 2013, this has been the best performing of the 11 subsectors that compose the portfolio. We saw a total return of more than 300%, 340% through the end of 2022. And that's after the substantial decline last year when the sector was down more than 40% in 2022. So what's going on here is that there is an arms race to automate supply chains and warehouses around the world. And that race was started by Amazon, which is now running one of the largest warehouse robotics operations in the world. And that's really enabling increasingly short delivery times from click to order to delivery. And everybody else in the e-commerce industry is basically scrambling to compete with this operational excellence. And it's not only about the boom in e-commerce, but also traditional retailers that are building omni-channel operations that are then feeding that huge transport and logistics industry that is facing a significant labor shortage issue nowadays. So there's tremendous growth in demand for logistics and warehouse automation, and it's important to understand that more than 90% of the 20,000 or so warehouses in the US today have no automation at all in more than 90% of those warehouses. So we've identified the best-in-class companies that are at the forefront of this trend. And today we have 10 Robo Index members that are focused on that, and they account for about 14% of the portfolio. So you will find companies like Daifuku in Japan, that is the global leader in material handling equipment. You have GXO, that is used by some of the largest blue chip companies to outsource their order fulfillment or logistics operations. You'll have companies like Zebra, that is the global leader in automatic identification and other track and trace technologies for supply chain. And Zebra was actually an early investor in Fetch Robotics that's made the headlines this year. Fetch Robotics makes autonomous mobile robots for warehouses and distribution centers and manufacturing and so on. You'll find companies like Manhattan Associates, that is a leader in the warehouse management system, so that is on the software side. You'll find a company like Cardex, that is based in Switzerland, that makes automated storage and retrieval systems. And then you have AutoStore from Norway, which is a warehouse robot technology company that invented the cube storage automation. That is a very dense solution for order fulfillment that you can basically bring into an existing warehouse and automate it in a turnkey fashion. And so AutoStore was the best performing stock in the Robo Index in Q4. It was up more than 65%. That's coming after a very volatile year since it went public at the end of 2021. They're doing really well. You look at a sales growth that's well over 50% year over year, and a business that's already very profitable with EBITDA margins over 50%. So that's logistics, but as many of you know, the Robo portfolio is exposed to many other very strong robotics applications, from manufacturing to healthcare and business process and food and agriculture. And in fact, the Robo portfolio is very diversified. And it's not only across the 11 sectors, but also across market cap. You have about 40% in large caps, but more than 60% in small and mid cap companies. And it's also diversified across regions, and that's a truly global portfolio. In fact, you can see around 45% in US stocks and about 55 to 60% in another 12 different countries. And the reason I bring this up today is because Robo has relatively high exposure to Asia at around 30%. And that's important because, first, Asia is where we're seeing the strongest growth in demand over the long term. And China already is the largest market for robots today. And second, it's because we're seeing China reopening and relaxing the vast majority of the COVID-related constraints that have been in place and really holding back investments in the last 2 years. So with China reopening, we're quite optimistic when it comes to the Asian piece of Robo. And that is not so much Chinese companies, but really exporters into China. So we have about 20% in Japan, companies like Fanuc and Yaskawa in factory robots. And then you have a good number of the technology and market leaders in key components that go into automated systems, like high precision gears from Harmonic Drive or Nabtesco. You have linear motion control from THK. You have pneumatic components from SMC and so on. And with the big move in the Japanese yen in the last 12 months, the Japanese exporters have gained a significant competitive advantage that we think they will benefit from this year. Now, before I pass it on to Lisa, I want to come back to my earlier comment about the discrepancy between stock prices and the reality on the ground in the automation industry, where demand remains very strong, despite all the talk of recession. And I'm not saying it will not soften, but it's remarkable how the fundamentals have remained very strong. And at the same time, valuations have dramatically compressed. And so today, the ROBO index is trading around 20 times earnings. That is down from a high of more than 35 times in 2021 at the high. And today we're at a discount to the long-term average valuation. And in the meantime, we're seeing the earnings of those best-in-class robotics companies. They've remained on that a really good-looking, growth trajectory. In fact, we're looking at sales growth of 11% in 2022, and the expectations for this year, 2023, are also around low double digits, and that is significantly above what is expected from the broader market, the S&P 500 or global equities. So with that, we'll pass it on to Lisa to discuss healthcare technology.
Thank you, Jeremy. ROBO Global Healthcare Technology Innovation Index HTEC is a strategy that we launched in 2019 that captures the growth of the digital transformation that we're seeing in the healthcare industry today. It has a very strong focus on the next generation diagnostic solutions, as well as the innovation that we're seeing in medical IoT and data-driven technologies. After several challenging quarters, HTEC had a solid performance in the fourth quarter, increasing 6.9%. The performance was driven by robotics, medical instruments, and diagnostic subsectors, which all gained double digits, while underperformance during the quarter were in genomics and data analytics subsectors. Overall, 2022 was a challenging year for HTEC index members versus the global market indices. So we were really encouraged by the strong performance during the fourth quarter, with 6 of the 9 subsectors posting positive returns. HTEC index for the year declined approximately 33% compared to broader market indices of 18% decline. For the year, precision medicine was the best performing subsector, down just about 10%, while the genomics and data analytics were the worst performing subsectors. So with genomics declining over 60% in 2022, we want to share our thoughts on the subsector and highlight a few of our index members that drove the performance. We strongly believe that we're still in the early innings of a multi-year cycle of genomic technology, taking a center stage in drug discovery and also enabling that life-saving diagnosis for rare diseases and cancer. The index members in the space are truly transforming healthcare. The biggest reason for the sell-off was that many of these companies were trading at very high valuations due to the strong growth prospects. Investors were waiting for the company to just grow into the valuation. Overall, we believe the fundamentals have not changed. In fact, we're seeing breakthroughs and acceleration investments from large pharmas to medical device makers in the genomic space. While we saw a steep sell-off and maybe some of the valuation resets were necessary, we're already starting to see the genomic companies recovering from some of the deep losses that we saw in the past year. Companies in our genomics and precision medicine subsectors, for example, like Veracyte, Guardant Health, and Exact Sciences, are starting to show signs of recovery. For example, index member Veracyte beat and raised their forecast during fourth quarter, driven by higher than expected sales of their cancer diagnostic test. Veracyte uses AI-enabled genomic technology to speed up medical diagnosis, so doctors can provide early treatment for those at high risk for thyroid and prostate cancer. Meanwhile, Guardant Health declined over 70% last year, as their growth slowed to just less than 20% top-line growth from 30% growth from the prior year. They're emerging to be an important player in the liquid biopsy market in the areas of colorectal cancer, and its share prices may continue to be volatile. But they do have one of the most interesting portfolios in cancer monitoring, profiling, and diagnostics. They are in the early stages of building this platform and demonstrating the power of genomics and epigenomics, which is an area that you're going to hear more about in the coming quarters. Shares of Guardant are already getting a good bounce for the year. We think many of these transformers of healthcare are truly oversold, as investors de-risk their portfolios in the last year. Exact Sciences, another index member which specializes in cancer diagnostics, had share price gain of 50% during the fourth quarter, and year-to-date of another 20%, was a good indication that these companies were in an oversold situation. So while the companies in our genomic subsector did experience tremendous volatility in the past year, the severe multiple compressions have also provided significant upside opportunity for 2023. Long-term drivers and demand for genomic technologies have only strengthened, and we believe that our index members are very well positioned for the rest of the year. Meanwhile, we're also very excited about the medical instrument subsector, which holds the biggest weighting for HTEC at about 25%. It experienced strong gains during the quarter, driven by hospital procedural recovery and a very large M&A deal for one of our index members. In November of last year, we saw one of the biggest ever acquisition in the medtech industry, with Johnson & Johnson acquiring a Biomed, our HTEC index member that we have held since the creation of the strategy. The Biomed was acquired for $16.6 billion by J&J during the quarter, a 50% upside from the closing price. The company developed the world's smallest heart pump and had over 18 years of profitable growth, and was well on its way in disrupting the $77 billion cardiovascular industry when it was acquired. While medical instrument subsector gained about 12% during the quarter, it did negatively impact the attribution for the year due to the heavy weighting of the index and ongoing supply chain disruptions that hit many of the device companies. Longer term, we are very bullish in the medical instrument subsector, as many of these index members are not providing just the essential products for the medical procedures, but we're seeing tremendous innovation accelerating, and environment seems to show signs of improvement as people are getting more checkups and book their appointments for their surgeries that they have held off during the pandemic. As we look out into the year, we feel really strongly that our index members with next-gen healthcare solutions will continue to be in strong demand as the world goes back to the pre-pandemic levels. And our HTEC is very well positioned to benefit from much of the secular growth drivers out there. Thank you, and now I will turn it over to Zeno, who will discuss THNQ.
Thanks, Lisa. Now I'm going to talk about the ROBO Global Artificial Intelligence Index THNQ, which provides exposure to companies around the world leading the AI revolution across infrastructure and both broad and vertical applications that are expanding GDP, creating new markets, and improving human condition. We launched the index in 2018, and the space has seen incredible growth and progress since that time. It would be remiss to not talk about generative AI and ChatGPT, but first we'll cover some Q4 highlights and performance. The index rose 4.4% with a continued fall in valuation down to around 4.7 EV sales at the year end, with performance down 45% since the November 2021 peak, where it was trading at 9.2 forward EV sales. So reported Q3 earnings saw sales growth of 18.5%, which is below the long-term average of 23%. And on the flip side, we saw EBITDA growth accelerate to 32% growth. So breaking down the performance, we saw 8 out of the 11 subsectors in the positive territory, with semiconductor, consumer, business process, factory automation, and e-commerce up. While we saw what had been a multi-year long subsector darling, network and security down 8.1%, with companies like CrowdStrike down 36% on conservative guidance cuts for the 2023. Big data and analytics was down 4.7%. And I'd like to highlight that forward EV sales have dropped from a relative high of 13x down to 4.2x. A company I want to talk about quickly in that subsector in big data and analytics, Alteryx, which is transitioning from a pure play observability platform into a more deployable automation platform for the enterprise, was down 9%, even with a 12% top line beat and guidance raised 14% for revenue and a 30% EPS raise. We also saw MongoDB and Splunk decline. And they're, these are all now at or below all their pandemic gains. We are optimistic going into 2023 that this is the year of AI prime time for adoption and deployment. From a financial perspective, out of our 68 holdings, 90% are projected to have positive EPS this year, with as many as 5% expected to cross that threshold in the profitability. So looking at how we deploy and look at our index and allocation, We have 54% into infrastructure currently. And breaking that down, we've got big data analytics, semiconductor, network and security, cognitive computing, and cloud providers. So I want to briefly highlight semi, which represents the largest weighting here. If you were here for our last call, you might remember me talking about semi being dead, long live semi. And at that point in time, semi had been the worst performing index of the year. Everyone was very nervous about the space, seeing declines and inventory build up. And kind of what's happened since then is, we had the CHIPS Act passed, which was actually in the third quarter, but semi was our best performing subsector. And we saw several companies, especially those tied to AI, which is all of our companies, cloud and automotive, outperforming the general outside of Think companies that have higher exposure to consumer markets, PC and mobile, which is seeing a slowdown due to oversaturation, inflation, et cetera. So we saw some companies with some great performance, and some of this is just a rebound, but they're still trading well off any sort of high. So we had companies like Infineon up 38%, Ambarella up 46%, ASML up 32%, and NVIDIA up 20%. Kind of piggybacking off that, we've seen over $200 billion in investments announced in U.S. semiconductor manufacturing capabilities expected over the next decade, benefiting from the CHIPS Act passage. A couple other highlights include Ambarella announcing a partnership with Continental for advanced driverless systems and smart dashboards. ASML announced plans to boost CapEx to produce their flagship extreme ultraviolet machines. And this expected boost is expected to generate additional $6 to $10 billion in revenue from their guidance by 2025. So that's a pretty massive increase in their expected demand from their customers. The customers being companies like Taiwan Semiconductor, Intel, and Samsung, and other big foundries. Despite this news, ASML is still trading 25% off previous highs. Now switching over to applications, which includes subsectors, consulting services, business process, e-commerce, healthcare, factory automation, and consumer. We saw consumer and e-commerce as leaders here, with consumer up 13% and e-commerce up 6%. Kind of the flip side of this also, we had seen these two subsectors also the other biggest laggards alongside semiconductor up until Q3. So we're seeing a sign of resurgence and reversal of oversold conditions, with strong performance from Shopify, Netflix, Booking.com, and JD.com. Now I'd like to switch back over to what I previewed earlier, which was generative AI. During the fourth quarter, we saw the introduction of the publicly available ChatGPT, which is from OpenAI, which is partnered with and runs on index member Microsoft's Azure AI platform. So I think everyone's thinking right now, what end markets, enterprises, human behavior changes could be affected, and how does that change the flow of value across society, in organizations, and governments? We expect Microsoft, for example, to integrate this tech across all products, as they have exclusive access to license the back-end technology versus the public-facing tech, such as ChatGPT, which is what is available for us to play with right now. And so we expect this commercialization and subsequent downstream utilization to further benefit and accelerate the space and adoption of AI. Core enterprise products, page and image generation, communication, and even healthcare can be affected here. As a reminder, Microsoft acquired Nuance, which provides conversational AI and tools for healthcare, such as transcribing. And we're excited to see how that could help reduce administrative burden in the healthcare space. And overall, we're excited to see what can be built to improve positive human experiences here. So kind of shifting back to that Azure AI platform, which is what this is running on, remember that itself utilizes many components that comprise the AI stack, which many people don't realize or think about. You see this on the surface, and then underneath is, think of an iceberg theory. So you've got other index members such as Pure Storage, Arista Networks, and then many other involved in software development and developer operations that are in the index. that provide ongoing software support and tools to keep this uptime, to make sure it's running securely. So we expect increase of AI network and cybersecurity spend to come from increased utilization here. A recent McKinsey report that came out on the state of AI in this last in Q4 highlighted that just about 50% of organizations that they surveyed have at least one business unit utilizing AI, with the highest percentage being robotic process automation. And they're seeing very clear benefits on cost reduction and revenue increase. So there's a difference between adoption and exploring, experimenting, and then driving business. And right now we're in between that exploring and experimenting stage. So we're really in the early innings here in terms of adoption and spend in this space. And we expect, for example, generative AI to be a potentially $100 billion plus industry over the next decade as it becomes more integrated into different products and parts of our lives. And I'd like to highlight that while we are seeing record layoffs, AI spend is expected to accelerate this year. So we even believe that in a harsh environment, this trend will persist as the need for reliability, uptime, product modes, cost reduction will drive competitive economic demand. With that, I'd like to pass it back to Jeremy. And
Okay, thank you, Zeno and Lisa. And now we're gonna take your questions. So feel free to type them into the Q&A box at the bottom of your screen. And I want to remind everybody that at the end of last year, we published our 2023 Trends Report, in which many of the more exciting growth stories around robotics, healthcare technology, and AI are explained in detail. So please refer to that report. It's available on our website at roboglobal.com. So I see we have a few questions coming in. Reminder, you can type them into the box at the bottom of your screen. First question is around the apparent shortage of workers. Are there any indications that demand for automation in the workplace is already accelerating? And yeah, I think the clear answer is yes. We're coming out a record year in terms of demand for all sorts of automation equipment and software. The growth trajectory is clearly inflected. I think first around 2017, 18, when the technology made it possible to adopt automation in a much bigger way across a broader scope of applications, but it inflected again coming out of the pandemic. And that's when we had the supply chain problems all around the world, and a clear acceleration in terms of the digitization of the economy. So we've seen that play out over the last 2 years in particular. Now there's signs of a slowing economy clearly in the second half of last year. The consumer spending still very strong, but in the manufacturing world, we've seen some softening. Indicators like the PMIs have come down quite abruptly. Yet the volumes in terms of the orders for automation have remained extremely strong. In fact, we ended the year 22 with record high backlogs. And so to give you a sense of the trend here in North America, demand for factory robots was up more than 25% year over year in 2022. So there's this backlog of orders that give automation companies the confidence that they have the visibility to have yet another good year in 23. And Zeno, maybe you want to comment on what you're seeing on the tech and software side.
Hey, yeah, thank you. So in terms of just automation and adoption, I mean, I'm going to kind of point back briefly to the McKinsey report I just alluded to, but adoption in AI, for example, is still very low in terms of it actually driving or being a part of many business units across the enterprise. That isn't to say that it isn't impacting various functions across these organizations, but I think to also look at another area where you're seeing fast adoption is across the government. So I think there's an acceleration of adoption in the government, partially due to there's lots of overhead and things move very slowly. I don't know if you've ever been to the DMV or done many government interactions, but there's a lot of processes that have been very manual over the years. Human Health Services Administration is also had a huge contract with ServiceNow. So I also across real assets tracking, a company called Samsara, for example, tracks real assets and gives analytics on performance and helps communication with not just employees, but also customers that are in municipalities. So I think you're seeing a pretty quick uptick of this across not just the US, but Europe and rest of the world. So there's a lot of untapped opportunity here. And all the trends show that there might have been in some areas, some sales cycle slowdown as last year things started to get a little edgy. But, so far it looks like forecasts are up across cloud, spending in AI investment automation. I think ChatGPT, for example, there's another question on that, and can tie into that, but I believe that will pique a lot of interest, and it will be surprising if not every single company in the Fortune 500 is using this technology in some way or another by the end of this year.
Thanks, and so following up on that question around ChatGPT, how do you see the deflationary pressure created by these kind of new tools, and how is that likely to manifest?
I think deflationary is one way to look at it. Obviously, other drivers of inflation or deflation that are a little bit more macro, it would be around energy and transportation automation. So I think looking at it as a deflationary measure first is, I think we should be thinking of it more of how can it help reduce the friction for achieving services or getting goods or products, or even just working through creative process or speeding up things, especially in legal and healthcare. I think it's a mix of just actually providing best practices to people that need it and deserve it at a lower cost, because a lot of times these services are out of the reach for many people. So I think there's a democratization here that's really important that will scale across the globe. In terms of deflationary pressure, sure. I think you're going to see, COGS of many different, the way that money is spent will increasingly go into AI, and you'll see a lot of other KPIs improve. So, we're early innings here, but that's what we believe. It's a good question. We'll just see what happens this year.
Thank you. I see a question around margins with some market strategists anticipating margin compression in 2023. Where do we see that as a possible risk across the portfolio? I think that's a very good consideration. Clearly, the cost side of the equation still going up. We've seen a lot of automation companies take price action last year to cover some of the raw material cost increases. So you think about, for example, warehouse automation that we discussed at length today. Metal is a big component of the bill of material for many of the solutions, whether the cubic storage solutions or even just material handling equipment in general. And steel can be, anywhere. Steel and aluminum can be anywhere from 10 to 25% of the bill of material there. So most companies that we track have taken significant price action. And that means that they suffered from margin compression in the first half of last year, and then recoup some of that in the second half of last year, and going into the first half. We think that will be a pretty neutral impact. So overall, we're not anticipating a margin decline for the entirety of the ROBO portfolio or in aggregate. In fact, when we look at the estimates for 23, we're still looking at a double-digit top-line revenue growth, around 11% year over year. And in terms of EPS growth, we're just around the same level. So no change in the margin assumption in aggregate. And then I also like to highlight that there's a big portion of the robo portfolio that's geared up to factory automation. That's where you have a lot of capital goods involved, and where you can see those dynamics with the raw material cost having an impact. And so factory automation is about 1/3 to 40% of the portfolio, but the remainder has a lot to do with services and software, where we don't see the same margin dynamics. And so I think overall, Robo is relatively insulated from those type of problems. Shifting back to one of the earlier questions, and I'd like for you to take this one. Can you think about some areas of underpenetration for automation tech, and discuss how spending could be cyclical or less cyclical depending on what we're looking at?
Yeah, I think in a way we've answered this both in our discussion earlier and in some of the Q&A, but I think in terms of under-penetration, well, a couple ways to look at it. There's things that are already in existing place, such as organizations, and there's also, as an example, bigger macro trends such as reshoring, and you see companies like Apple that are shifting iPhone manufacturing outside of China to India. All these things are going to require increased automation, especially if a company like Apple, just talking, Jeremy, about margins. If Apple wants to maintain their margins on something like the iPhone, they're going to have to automate more of their processes to get those margins coming out of producing iPhones in India. In the US, we're seeing, it seems like every day we're getting a new announcement on a battery plant or an EV plant, or you've got the CHIPS Act, which we expect to be a little bit more of a meaningful contributor in terms of purchases in 2024 and beyond. But those chips are being laid out. Just on the robotics side, there's strong pricing pressure and underappreciated opportunity there in terms of underutilization so far. In terms of kind of other ways, I've already mentioned legal space. Legal's been working on automating different processes for many years. Same with healthcare. I think the administrative side is a huge angle that I hear for my channel checks. Doctor administration time is still a terrible thing, and I think the technologies coming out today, once they get deployed, will meaningfully increase the quality of interaction with doctors, as they're not going to be as stressed as taking notes afterwards, and more of that information will be captured and put into the proper place. This should help reduce the administrative burden of costs. So hopefully insurance prices go down as admin costs go down and quality of outcomes go out. And then I already mentioned this earlier, but just government spending in AI and automation outside of military has been fairly low overall. So expect to see, even with kind of flat or depending on whatever direction the market goes this year, I think you're going to see per the McKinsey report, increased adoption not just of robotic process automation, but other types of autonomous systems for those organizations.
Okay, I see we have one last question for Lisa. Unfortunately, Lisa had to run, and so I'm going to take it for her. And that's a question around the valuation metrics of HTEC, the Healthcare Technology Innovation portfolio. So HTEC is a little bit different from Robo in terms of what valuation metrics we look at. And that's because Robo has the vast majority of its members that are highly profitable, already established companies with proven track record and typically fat margins, high returns. And so for Robo, we like to look at the price earnings for the portfolio in aggregate. And I mentioned that for Robo, we're standing around 22 times right now, which is somewhat below the long-term average. When it comes to HTEC, because there's around 1/3 of the companies that are not yet profitable, so you think about genomics, you think about some of the next generation diagnostic solutions, and then those type of firms are typically in a higher growth scaling phase, and they have negative accrual earnings. So we like to look at the sales multiple, typically the enterprise value to sales. And today for HTEC, we're at around 4.5 times. And it's a little bit up from the low that we reached last year at 4 times, but it's significantly down from the highs of 21 when the fund was trading around 7.5 times sales overall. So we're down to 4.6 right now. The long-term average is between 5 and 6. So we're substantially below the long-term average. In fact, the current level is comparable to the trough of 2020 at the height of the COVID panic. And so overall, I think it's fair to say that the HTEC companies today are trading at valuations that are far from the highs of the euphoria of 21 and actually much closer to the panic kind of levels. Okay, so let me do last check on the questions. I think we've covered it all. So I want to thank everybody for joining us. You can always reach us via the website, roboglobal.com. You can ask your questions directly to the research team. That's also where you sign up for the newsletter that we send every 2 weeks or so, and in which we share some of our research on a regular basis. So thank you, everybody. Wish you a great day, and we look forward to talking to you again soon.